Trump's tariff wars could have profound implications on one of the world's most crucial resources, oil. China, a major buyer of U.S. oil, has already imposed a 10% tariff on imports. Meanwhile, Canada, the top oil supplier to the U.S., faces uncertainty as the U.S. considers reinstating a 10% tariff on Canadian crude imports. If you invest in oil futures, here is what you need to know about how tariffs could affect the price of oil. The U.S. crude oil futures benchmark is the West Texas Intermediate, WTI, while Brent crude sets the global standard. Despite being the world's top oil producer, the U.S. still relies heavily on imports. That's because most American refineries were built before 1977, at a time when the U.S. imported a heavy type of crude to process. Since the 2010s, domestic production has surged with shale oil, a much lighter crude that many U.S. refineries can't handle well. As a result, in 2023, the U.S. imported an average of around 6.5 million barrels per day of crude oil, more than the average of roughly 4.1 million barrels per day it exported that year. Which brings us to Canada. As we can see from this chart, Canada has been the main source of oil imports to the U.S. since 2014. The two countries are deeply reliant on each other in the oil market. Pipelines like Keystone, Enbridge's Mainline, and the Trans Mountain system connect Canadian oil fields to the U.S. refineries, particularly in the Midwest and Gulf Coast, making Canadian crude the most accessible and cost-effective oil for the U.S. At the same time, Canada exports about 80 to 90% of its oil production to the U.S., so losing this key buyer would be a major blow to its industry. A tariff on Canadian oil would likely push U.S. gas prices higher while also driving up WTI and Brent crude prices due to the added tax on Canadian imports. Canada has limited alternatives for where to send its oil, and the U.S. doesn't have many options for heavy crude either. While Venezuela is a potential source, political tensions make that unlikely, so both sides face significant challenges if tariffs are applied. China is one of the biggest importers of U.S. oil, so if the trade dispute between the U.S. and China worsens, that could hurt demand for U.S. oil, leading to a decline in U.S. benchmark oil prices. Global oil prices may also fall because the U.S. will be looking elsewhere to export the oil that China isn't taking in, contributing to available global supplies. Tariffs aren't the only factors playing into the global crude price moves. President Trump has enforced sanctions against Iran, which exported more than 1 million barrels of oil per day in 2023. There's also OPEC Plus, which plans to phase out its voluntary production cuts starting April 1st, so they will gradually add to global oil production. President Trump has also campaigned on boosting domestic oil production with his drill baby drill mantra, but some experts wonder if there could be much of a boost, as the U.S. is already the leading producer in the world. A lot could change with regard to tariffs. China may change its stance on its retaliatory tariffs, and the ones with Canada may never go into effect. But the constant day-to-day changes in Trump's policies have certainly proven their ability to shake up the oil market.